Hey guys, this is Bill with NotaryCoach.com. I want to talk a little bit about a certain topic that comes up in loan signings actually quite a bit. Probably one of the most common conversations or questions that you might get during a loan signing is why mortgages are sold on the secondary market. A lot of times these mortgages are originated with one company, and then before the first payment's even due, the lender will sell that loan to another bank, an investment bank, or sometimes it's a mainstream bank, sometimes it's just a loan servicer, and that's very, very common. In fact, it's probably somewhere around 80% of all loans are sold that way at some point during the life of the loan. In our case, as a loan signing agent, when you're signing for a brand new home these days, there's a really good chance that that loan's going to be sold by the time the first payment's due. And then other times on refinances, it just kind of depends on the situation. And there's really two main reasons that a loan is sold on the secondary market. And it really has to do with just freeing up capital so the lender can continue to borrow money and then lend money as well. So they're in this constant shuffle of balancing their loans versus their credit lines. So the grand majority of them will sell the loans just so they can continue lending and operating as a business. That's pretty common. Then some of the mainstream banks, like your Wells Fargos and Banks of America, where they have other products that they offer, they are regulated and they have to constantly balance those savings deposits versus the loans that they have going out. So it's this constant shuffle that's happening in the background. As far as the impact to the borrowers, it's really not too much. For the most part, there's never going to be any change in the terms or payment of a loan, no matter how many times it transfers. Now, occasionally, there will be little differences in the way property taxes are balanced, or flood insurance can sometimes be impacted by that. But for the most part, literally, it's just a matter of making their payment to a different lender whenever that transfer occurs. The borrower is going to actually get a notification from both their current lender and the new lender that will probably come in mail. And one will say, hey, we've just transferred your loan over to, say, US Bank. Here's your new loan number. And then you'll get a letter from US Bank that says, hi, we've just taken over the servicing of your loan. Here's your loan number. You just make sure those loan numbers match, and you're good to go. It's super smooth for the most part. There's always exceptions, guys, and you're going to hear those stories too. But for the most part, when you consider how many millions of mortgages transfer every month, or hundreds of thousands of them, it's actually a pretty smooth process. Now, as the signing agent, you're not going to dive too much into this because that's outside of your realm of expertise, and you don't want to get into any legal gray area. So if they have deep concerns over this and they want to talk to their lender, you can certainly put them in contact. I've never had that experience, though. People are always curious about it, especially first-time home buyers, because they don't understand how it all works. But when I say, it's just how one lender frees up capital so they can continue lending, that usually makes sense for people, and they'll do it. Everybody has a real strong opinion of banks that they like and banks that they don't. So that's usually you're gonna hear some feedback on that too. You just don't want to say ever anything disparaging about a lender or a potential new client. So just keep that in the back of your head as you progress. All right, guys, that's kind of a real broad overview of as to why mortgages get sold on the secondary market. I hope that's helpful. Just a morsel of knowledge in your arsenal so you can have that conversation if it does come up. This is Bill with NotaryCoach.com. Have a great day.